Hi, in this video I'm going to dive into the Southwest Riverside County real estate market and give you an update and talk about what the experts think about a bubble bursting locally. Thank you so much for joining us. I'm Tom Olsewski with eXp Realty, and really quick, just wanted to get into what's going on in the market within the last week. There's been a major change in the real estate industry, and we're seeing an effect of the number of pending sales. Does it mean there will be a market crash? The experts don't think so, so maybe just a speed bump while agents try and figure out how the new documents will work with buying and selling homes. Everybody's trying to put together these transactions, and there's just a new way of doing business. This is going to mess with the data for the next few weeks, and then it'll iron itself out. Because there's a statistic, it's like 72% of all real estate agents have this figured out, and it's business as usual. But for a number of agents out there still, there are a number, 28%, that still are having a little bit of an issue with this new change and trying to figure it out. Our brokerage at eXp has spent significant time reviewing the best way to approach the new changes and have us trained on how to handle this new situation and paperwork to protect us and the prospective home buyer. So it's affecting all the metrics. So you gotta take everything with a grain of salt, because what it's showing right now is inventory is continuing to grow slightly. It looks like it's about to peak and demand is dropping on a weekly basis. Interest rates are actually improving and coming down some. So with interest rates continuing to improve and the Fed set to be cutting rates, you're going to see an improvement in the overall demand readings, not continuing to go down like it is right now, although the end of year stats will come into play. So the market's continuing to slow a bit right now, and this is it just has to do with the new industry standards that they have been doing now for nearly 3 weeks. August 17th it kicked in. So let's get right into today's topic, and that is the local housing bubble about to pop. And I'm talking about the slowdown that we're having the last couple of weeks. And this slowdown illustrates, things are not as fast as they were before. But does that mean that the market is going to pop, explode, implode? And let's get into it. Affordability is the primary factor that has been holding back our current real estate market. And we have records that dials it all the way back into the 80s, 1980s. So that's the last time we had this on affordability across the United States at the level that we have right now. It's very, very, very close to the peak time of the Great Recession, the great financial crisis right there in 2007, 2008. So there are 3 things that go into affordability, and the 3 ingredients to affordability are values, and the only way to fix this so that things are more affordable are values to come crashing down, or for incomes, number 2, to absolutely skyrocket all of a sudden, or for mortgage rates to drop considerably from where they are today. So property prices aren't all of a sudden going to cave. That's not what it is and that's not going to happen, and I'll explain why. A lot of people think and they remember what happened in the Great Recession. When values got so high that this thing's going to implode. It has to implode, right? Not this time. It wasn't necessarily because values were so high. It had to do with the supply and demand. All of a sudden, the demand shut down completely and supply boomed. And that's not what we have today. People remember the burn of the Great Recession, and that's why it's brought up over and over and over again as to why or where the market should crash, right? Values should come tumbling down. That value asset, the asset bubble of home values should pop, and values should come back to where they were before. And I hear a lot of people say that they should come down, all the way back down to the 2019 levels is where they should be, or the start of the 2020 prior to the pandemic. And so, but this is not the Great Recession. Where are we right now? Yes, we're actually experiencing a slight slowdown right now, but it's not the garden variety issue of like a major meltdown in the financial institutions, not only in the United States, but around the world, like what happened during the Great Depression. And what happened during the Great Financial Crisis, also known as the Great Recession, but now this is not a Great Recession. What's about to take place, and I know that's so many people are rooting for because so many people actually think it's a bubble. So many people think it's going to be a crash. It's like 2/3 of the millennials and Gen Z think that the market is going to crash, and that's going to be their pathway to purchasing. And I understand that. But there's something else that they could be rooting for. But let me explain why it's not the Great Recession. And that is, you got a total of housing and inventory right now. So the only way to make their property stand out was by price. So you compare the supply glut and demand during the Great Recession to the supply scarcity that we're dealing with right now. We don't have enough homes to sell. Yes, inventory levels are way higher than where they were last year, but last year kind of established this real bottom. It was not a good year for inventory. As a matter of fact, inventory, it doesn't normally do this, but inventory continued to fall from the start of the year all the way through April. And that is not normal. So we have a supply scarcity problem that's been around since the start of COVID, and it really has not fixed itself. There are a few markets that are right there prior to where they were prior to COVID, and you could see that in Texas and in Florida and also Idaho. But that's not what's common across the United States. It's still far short of where they were prior to the Great Recession. I mean prior to COVID. And so it really becomes a demand and supply issue. And that's kind of where we are right now. So we're dealing with a very, very low supply. And it is being matched up against a very, very low demand. So if you have a lot of supply matched up against a very low demand, like we did during the Great Recession, well, that totally favors buyers. And it was so in favor of buyers that value actually plunged big time here in our area. Now today we have limited supply and limited demand. They kind of wash each other out. As a matter of fact, the supply has been such a limited resource that it's allowed values to actually continue to climb, even this year and last year. And I'll show you some slides for different cities. So that's one portion of it, is supply and demand. And we just went into where the supply is, and now we're going to talk about the purchase applications, which you can kind of translate a little bit to demand. But it also talks about how easy it was to get a loan prior to the Great Financial Crisis. And prior to the Great Financial Crisis, you can actually see that there were more and more people that were trying to apply for mortgages across the United States. This is purchase applications. It absolutely was spiking all the way until we got to about 2005. And then from there, things started to really drift south. But then you can compare that to where we were from 2012 all the way to 2021. And you could see that that the application index, even prior to COVID, was relatively flat and slightly rising. But of course, in 2021, it just balloons because rates dropped to such low levels. And look where we are today. So you actually now have to qualify for loans, and they're very diligent on qualifying. That's why average credit scores have gone way up. That's why people have good jobs, have been purchasing for such a long period of time. It's not easy to get a loan any longer. As a matter of fact, this shows you how easy it's been over time. The Mortgage Credit Availability Index, which goes back in history of this thing and goes way, way back, and the Mortgage Bankers Association keeps track of this. If you look at it, this shows you where we were in June of 2004 to where we just, when the Great Recession hit. It peaked out where it was super easy to get a loan. Now you compare that to where we are today, and even prior to COVID, it was actually a little bit easier to get a loan than it is right now. So you really have to qualify for a loan, and you're going to be put through all of the hoops in order to prove that you can make the monthly payment, because no bank wants it back like they did during the Great Recession. So they just don't want a repeat of it. A lot of this is thanks to Dodd-Frank. There aren't many adjustable rate mortgages that are out there anymore. A big portion of everything that went sideways was because of those. That was adjustable rate mortgages that adjusted on a monthly basis. There are adjustable rate mortgages out here today, but they're pretty much all fixed for 5 years, and then they adjust the prevailing rate to 7 years or even 10-year fixed. And it's not like the adjustables that we talked about that adjust every single month, and no teaser rates and subprime, and all that just doesn't exist anymore. So that's what we had prior. As far as the overall housing stock, all the houses collectively put together are extremely strong. And you can actually see that the housing stock has been built with strong credit. It's been built with a giant down payment as well, with solid jobs. It's a low fixed payment, which is our hedges against rising rents and also a hedge against rising inflation. It's fixed, and it's not like rent doesn't keep continuing to go up. Record tappable equity, which means you could tap your equity and still have 20% equity in your home, which is what banks like to see. And there is also a record number of homeowners out there that own their homes free and clear. It's gravitating towards 42% across the United States. It's a lot of people that if they get in pickles, it's not that painful. And that's not what you have to have. You have to have a lot of pain in order for there to be these big foreclosures and short sales that everybody is talking about that's going to happen. And guess what? It's not likely to happen. And that's just, this is not a single recipe for disaster. It's a way too strong. The housing stock and pretty much everybody refinanced right after we got into COVID in 2020. We hit 17 record lows in interest rate, and that started in March of 2020. All the way through the 17th was in January of 2021. And this is a lot of homeowners are just staying in their homes. They realized rents have continued to go up, but they refinanced and they had this low rate, and it's not going anywhere. 77% of the country has an interest rate of 5% or lower. 58% of the country has an interest rate at 4% or lower, and 22% have an interest rate at 3% or lower. And they're not in a rush to exchange those low rates for a new loan. Higher interest rate and higher payments and higher property taxes across the board. So that's kind of keeping people hunkering down. And you can actually see this. This is not just in Southern California, but the number of people that come on, the number of new sellers across the United States is low. And last year beat this year. It had the fastest growth, fewest number of homeowners that came on the market this year. There's a few more, but it's off by 30% compared to those previous years. Supply remains at really low crisis levels matched up against really low demand levels because of where interest rates are as of today. And that's what this tug of war has been all about. Supply scarcity, which favors seller, it's gotten a little bit better this year, so buyers have been able to pull back a little bit. So the affordability crisis favors buyers slightly. As interest rates continue to float down, you're going to see more and more demand, and they're not going to be able to pull back as fast. So there's going to be this tug of war. And right now, we're going to be peaking in the market. Interest rates are going to continue to slide down for the rest of the year, slowly but surely. So that's a recipe for more demand. Inventory coming down for a hotter market, and that's kind of where the markets are headed for the remainder of the year. So as far as waiting for values to come down and for the bubble to pop, that's not going to happen. You better not be waiting for values to come down, or all of a sudden for you to be given a gift and you double your income. Maybe that's not going to happen either. That's not what you should be waiting for. Not what you're rooting for. Instead, what you should be rooting for are rates to continue to slide down. The further they slide down, the better off you are. But the interest rates, we've already established the ceiling last October at 8%. Now we've made our way down to 6.4% and a little bit below where we are presently today, and where it's going to continue to go as the overall economy slows is below that 6% threshold. And we haven't been below 6% since August of 2022. And once we get an interest rate with a handle in the fives, anything that starts with a 5, you're going to see a lot more rushing demand, a lot more buyers entering the market, especially come 2025 when we have even lower rates and we have limited inventory. That's going to take hold really quick. And so we can definitely see a map for getting into the 5s. And that is as the economy continues to slow, which all the trend lines show exactly that. And as a result of what you've heard with the Fed is going to be making some cuts. It could be this happens about 2 weeks from now. We're talking about the middle of September. You're looking at least a 1/4 point drop or possibly a 1/2 point drop in September overall. If they only go a 1/4 in September, they're most likely going to go a 1/2 in November. It's the day after the election. So then they meet one more time in December. So there's 4 meetings. It could come down a full point. And so with that coming, and that's kind of what's built in today's mortgage rates. But things will continue to cool from here. And you can actually see this is the spread. There's kind of this love affair that goes on that's happened between the 10-year bond and the 10-year bonds, their government issuance, and the 30-year mortgage spread. So I actually look at the 10-year Treasury bond levels, and there's this goes all the way back to 1972, and the average spread is about 1.71. That's the average spread, and the spread is right now at 1.71. It's actually much higher than where it should be. It's almost a full percentage point higher we're talking about the mortgage rates, and that's because things are a little bit uncertain. The Fed is still doing this policy. We've had inflation, but inflation is coming back in check, and the Fed's going to start ratcheting down rates to get more towards what they call a neutral rate. Well, once we arrive at that, you're actually going to see this pinching of the spread. That spread is going to go back towards normal. So nothing can happen, and a matter of fact, down the road, maybe nothing happens and the economy continues just to ride along. And it continues to further slow. But as the Fed arrives closer to their neutral rate, you could actually see this spread fall. And when that happens, because there's an argument right now for interest rates to come down into the fives, and then once the spread goes back to normal, you can go down a full percentage point. So I can definitely see a pathway for interest rates to get all the way into the fives. The mid to upper fours, now that will entice a lot more demand, and it will definitely free up the ability to afford more. That's really what the bottom line is. Values are high today. They're going to continue to be high. This actually explains why I still believe it's a good time to purchase right now, is because you can always refinance down the road. As soon as the prevailing interest rate for the day is 1% lower than whatever the interest rate is that you have on your loan. So if you were able to buy today and it was at 6.4% and interest rates go down to 5.4%, you can refinance again. And let's say hypothetically, who knows, I'm just throwing out hypothetical, but they go down another percent. You can refinance again. You can refinance as many times as your little heart desires. So there it actually is. There's your positive in this crazy market. There's your beautiful sunset, that there's light at the end of the tunnel, and it's not a train coming. And that basically is that interest rates are coming down to make affordability improve, and so that this unaffordability that everybody's talking about will definitely improve across the United States and here in California. That's where we have reports, but it will improve everywhere across the United States. So that's why we're not going to have a bubble. It's not a bubble, it's not going to pop, because there are a lot of homeowners that simply do not desperately have to sell. And there, we just don't see a recipe for that to happen. I hope this information has been helpful, and I thank you for watching.